signing core principles for regulating the United States financial system. Doesn't get much bigger than that, right?
Donald Trump is returning to the White House, bringing with him welcome but also risky changes. At the forefront is the banking sector, which will see a relaxation of regulations. These will come close to levels comparable to those before the 2008 crisis. Does this leave the US facing a potential crisis of the magnitude of the one 16 years ago, or will the banks be able to stay on top and their shares benefit? Hi investors, this is Milan from 𝗕𝗂𝗶𝚀. None of the information in this video is investment recommendation. Always do your own detailed analysis. While the banking sector is looking forward to looser regulations and the possibility of higher profits, some analysts warn that looser supervision could open the door to new risks similar to those that plunged the world into the 2008 financial crisis. As Donald Trump prepares to return to the White House for a second term, the financial sector is poised for a new era of looser regulations and oversight, but most of all for the higher profits that could result. The former and now future president has long pushed for reduced regulation in all sectors. For banks, this will mean easing growing concerns about antitrust scrutiny and looming capital requirements that have slowed potential revenues from investment banking and lending. Wells Fargo analyst Mike Mayo said in a research note last week that Trump's victory will mark a decisive regulatory change for the banking sector, all of which would help boost investment banking revenues, loan growth, and a more pro-business approach that would boost bank results. Trump's victory especially calls into question the future of new banking requirements known as Basel III Endgame, which would force big banks to hold more cash. The international rules are aimed at strengthening banks' ability to cope with shocks, with regulators planning to introduce them by mid-2025. Brian Mulberry, a client portfolio manager at Zacks Investment Management, said the most likely change to Trump's policy will be to limit any increase in capital requirements. To explain, big banks are currently required to hold a 5% capital ratio, or a key pool of cash that banks keep on standby to cover losses and other interventions. The rules have already been relaxed from their original form, which proposed a 19% increase in capital requirements for banks with assets over $100 billion. In September, regulators announced a modified proposal that would require only a 9% increase in capital levels, after considerable opposition from top US bankers. It wouldn't be the first time Trump relaxed banking regulations. In 2018, Trump signed a law that raised the threshold for banks deemed too important to the financial system to fail from $50 billion in assets to $250 billion. That meant that more small and medium-sized institutions no longer had to undergo stress tests or submit crisis plans, which describe how financial institutions would handle bankruptcy or other failures. These safeguards were originally put in place to protect consumers and banks after the 2008 financial crisis. During his presidency, Donald Trump pushed for a policy of deregulation to boost economic growth and increase the profitability of US companies, including banks. The relaxation of some rules introduced after the 2008 financial crisis has created new opportunities for banks. On the other hand, however, these measures raise concerns that history could repeat itself and that the banking system could become vulnerable to the same risks that led to one of the worst crises in modern history 15 years ago. But history teaches us that with deregulation comes threats. Just as before 2008, when banks operated with minimal restrictions, today's more relaxed rules could lead to excessive risk-taking. Deregulation gives banks more room to experiment and expand into riskier areas such as speculative investments, derivatives, or lending to less credit-worthy clients. This was precisely the scenario that led to the creation of the mortgage bubble and the subsequent crisis in 2008. The relaxation of the rules for medium-sized banks means that these institutions do not have to hold as much capital as a hedge against potential losses. If there were an economic slowdown or recession, banks with lower reserves could fail quickly. This could cause a domino effect throughout the financial system. Trump's cancellations came under the spotlight last year after the Federal Reserve blamed them in part for the collapse of the Silicon Valley Bank and the subsequent regional banking crisis. Bank stocks rose quickly and significantly after Trump's election victory. And if you like and subscribe, our channel will grow as well. If Trump's first term is any indication, bank stocks will benefit from his second term. In 2017, the first year of Trump's first presidency, the banking sector gained nearly 30%. This outperformed the S&P 500 index by several percentage points, with most large banks doing even better. Bank stocks have performed exceptionally well this year and before Trump's election. The largest banks easily outperformed the S&P 500's 23% return, thanks to continued strong net interest income from higher and longer-term interest rates, which has underpinned a number of strong results. The broader stock market may be heading into an era of muted returns. Goldman Sachs estimates that the S&P 500 index will return 3% annually over the next decade, well below the 13% return over the past 10 years and the long-term average of 11%. Outperforming the index is the goal of every investor, and with a prediction that it will only grow 3% per year, it is starting to seem manageable. But other stocks won't be gaining as much momentum as they have in recent years either. Investors will have to look for hidden stocks with potential. A 𝗕𝗂𝗶ecie Black membership will help with this perfectly, putting content from across the market right in the palm of your hand. This revision is largely due to the high starting point for the next decade. Because total returns have been so high, it's typical that future earnings growth appears smaller in comparison. Goldman Sachs also projects a slightly larger decline in GDP over the next decade. Even so, it looks like the banks will really thrive under Donald Trump. Their shares are already trading at absolute highs, so the question is whether their price will go even higher. Do you have a representative of this sector in your portfolio? Good luck with your investments.